Guys, we're reporting on Roku and Shopify. Roku just reported. We're going to wait for Shopify, but it'll be in this video. You will see it before the end. They just reported. Guys, should we say that ARK investments are back?
I would say yes.
Kidding. Roku reported revenue of $867 million versus estimates of $804 million, so substantially beat. And they reported a loss of $1.70 per share, which was better than the expected loss of $1.73 per share. Now for Shopify, their expectations were $1.65 billion in revenue and a 2-cent loss per share. But we will get, once they report, we'll get you the information. Here is the Roku shareholder letter. This is for the entire year. Mo, what are you looking at?
I'm looking at the engagement. They had their increased 19%, streaming hours increased 19%, 87.4 billion streaming hours.
We're the number one TV streaming platform by hours streamed in the US, Canada, and Mexico.
Insane.
That's a lot.
Insane.
So a couple of metrics here. Total revenue grew 13% year over year to $3.1 billion for the entire year. Platform revenue, I don't know what the difference between total revenue and platform revenue is. Gross profit up 2% year over year to $1.4 billion. However, I will say, gross profit margin, this was last year, fourth quarter, 60.6% down to 55.8%, and total gross margin, 43.9% down to 42%. So decrease on both. All right, average revenue per user. Now this is, for those of you who are new, this is one of the metrics we look at for Facebook. Even though Facebook's user growth is basically flat and slightly growing, we think the average revenue per user has a lot of potential. Their average revenue per user year over year is only up 2%. Okay, 40.67 in Q4 of 2021, 41.68. That's not even keeping up with inflation. So that would be a concern of mine. Now, I'm not going to say I like this because it's always good, but I like that research and development is up 75%. So they're clearly going to get serious about, we use Roku in our house in Mexico.
I use it at my house in here.
Oh, you do?
Yeah.
I don't use it here.
I use Apple TV.
Oh, you like Roku as well?
I love Roku.
Yeah, I actually like Roku more than Apple, I think.
I do too. That's coming from me.
Yeah, and you love Apple. You love Apple so much, you want to take it down to middle school and get it pregnant. What's that from?
Disruptive. Wayne's World.
No.
I don't know.
30 Rock. Tracy Morgan says it when he's talking about, anyways, it's a great episode. The Entourage episode. Okay. Income loss from operations. Last year, this quarter was $21.4 million. This quarter, $250 million loss in operations. Okay. EBITDA, I don't really care for EBITDA because I agree with Charlie Munger when he says, when you see EBITDA, you might as well change it to BS earnings. He's right. And if you want to understand why, watch more of our videos, subscribe to our channel because I explain that in more detail. But even then, it's down a lot. So for those of you who buy into EBITDA, then that's not a good thing. Okay, outlook for 2023 first quarter. Total net revenue of $700 million, gross profit of $310. That'd be 40-some%, probably in line with what they're doing now. Expected to lose $205, and expected EBITDA loss of $110, which would be a big difference from their adjusted EBITDA of 57.6 in the first quarter of last year. Right? 4, 3, 2, 1. Yes. All right. So Mo, besides being the number one service, active account, look at this. 16% growth in active accounts, 23% growth in streaming hours.
Yeah.
How do they not convert to more average revenue per user?
Oh no. So all of these numbers that you're showing me, I'm actually surprised they didn't know they were still doing, I don't know if they were still having losses in different areas. I had no idea. I thought they were a profitable company. I mean, I don't really know. This almost takes me back. I mean, this thing is up 25% today if you include post-market.
Let's check that out. Yeah, you're right. And by the way, the all-time high was $490. The 52-week low was $38, and now it's at $72.
Wow.
Disruption, baby.
This is disruption at its finest. I cannot say that I'm almost in a too hard category / just avoid.
For me, it's too hard.
Yeah.
Because I don't know how they get to profitability, and when they do get to profitability, what's that going to look like? What's their gross margin overall? 46.6, and recently. So, I mean, we have all the metrics here. Return on invested capital is negative. I mean, there's nothing here. Free cash flow is negative. Their 5-year average free cash flow is $18 million.
There's literally nothing here that says this is a good investment. The only thing that's good is their growth from a viewer perspective, usership perspective.
So I will say this. The only metric I'd go off of here is price to sales.
Okay.
But my question becomes, how do I know this is a good price to sale?
I don't know.
What's another company that is established that has revenue solely based on a service like this? The revenue is purely based on a service like this.
I don't think anybody else, because every other company is a part of a bigger
Something
company.
else.
Yeah.
So I cannot say whether this is a good buy or not.
Yeah.
Now, for those of you out there who are looking to us saying, no, I needed to hear what was Roku's a good buy or not. Guys, we stick to what we know. If we look at this and we can't tell what the profitability is going to be, I avoid it. One of the reasons I also avoided this, Kathy Wood loves it.
I was going to say maybe you can compare it to Spotify, but they don't have hardware like this.
Since 2018, they had 106 million shares. Now they have 138 shares outstanding. Guys, this means if you own shares back in 2018, you were one of 106 million. Let's say you own one share. You split your profit with 106 million other shares. Now you're splitting that same profit with 138 million shares. You're being diluted. There are a lot of investors out there who won't even look at a company if their shares are up over the last 10 years. We're not one of them. We want to see a trend happening. The trend could be going lower. We also don't want them buying back expensive shares. Luckily, these guys realized that everybody was a crack addict right here and just started issuing shares instead of taking on debt.
Smart move.
Smart move.
Very smart.
Do we have Shopify earnings yet? Okay, what are the Shopify earnings?
Yeah, what do we got?
Remember, they're expected to lose 2 cents and expected to generate revenues of $1.65 billion.
EPS of 7 cents.
EPS of 7 cents, so they beat big time. And revenue?
Revenue of 1.73 billion.
And they're down. 1.73 billion. They beat on earnings per share and revenue, and they are down, right, Mo?
Yep, down almost a percentage point right now.
That's incredible.
Yes, it is.
So
Let's see.
52-week low is $23 on Shopify. All-time high was $176 back in November of 2021, and it's currently at $53 a share, give or take. Mo, what's it saying in the press release?
I'm just kind of scrolling through here. Good things that I'm seeing. They launched Spotify payments and
Shopify
payments and all these FIs. Disruptify. They launched it in 22 countries, so they're expanding. That's good. Let me see if we
By the way, I will say something about Shopify.
Yeah,
I
great.
think they're a great service.
Fantastic.
They're a fabulous service.
And they're really clean. I love the software.
Good gross margin, 50%. I got to think that might get better because it's just software. No dividend yield, no return on invested capital because they don't make money. Free cash flow last year was minus 200 million. Last 5 years, 77 million. Price to sales ratio, 12-1. Guys, Microsoft has a 68% gross margin versus 50%, right? And let's look at Microsoft's price to sales. 10 basically. So when you look at companies that when you have a hard time understanding the value of a company because there's no earnings or free cash flow, one way to take a look at them is to look at their price to sales ratio and compare it to other companies. Now, can Shopify grow a lot faster than Microsoft? Absolutely. But you have to assume that 10 on Microsoft is a reasonable number. I would argue it is not. I would argue it's probably supposed to be a little bit less than that. Go ahead, Mo.
Now it's down 5.5%, but I'm looking at the quarter.
Oh, wow.
Gross merchandise volume increased 13%. Total revenue, 26%. Merchant solutions revenue increased 30%. Subscription solutions revenue increased 14%. Almost everything increased. Let's see. Gross profit dollars grew 15%. Operating loss was 188.7 million, or 11% of revenue, versus an income of 14.4 million, or 1% of revenue from a year ago. So outside of that, everything got better, and the price is being punished. And if you look at a full year, it's almost the same situation. Wow. Okay, what's the outlook? Let's see. For the first quarter of 2023, we expect revenue in the high teen percentages on a year-over-year basis. Gross margins to be slightly higher. Okay. Let's see. Our expense growth is in low single-digit percentage versus the fourth quarter of 2022.
Stock-based compensation in line with what we saw, and capital expenditures being in line with capital spend of 2022.
So,
let's look at their capital expenditure from the cash flow statement. So guys, capital expenditure is a very important aspect of free cash flow. Free cash flow is cash from operations less your capital expenditures. So they had negatives all along the way. Obviously, when COVID hit, they skyrocketed. Why? Because they were probably growing. People had to do online stores, and it went like crazy.
Yeah, I'm curious to know. I mean, I understand these are in millions and it's a growth company, but is this sustainable? Where does it kind of settle down to? Does it tailor itself back to this maybe 2.4 billion, 3 billion, 4 billion, somewhere in there? That's something I might factor in if I do a stock analyzer on this one.
Yeah, but look
Just
at this.
because I'm coming off of a pandemic, but again, it's been over for people are
Wow.
not shopping online for a while, so maybe this is the
Guys,
new norm.
stocks in the short run are a voting machine, in the long run they're a weighing machine. Whatever Shopify ends up generating to its investors over a long period of time, that's where the stock will go. It's going to take a while to go hit that all-time high of 176. Think about it from here. Just from this standpoint here, $51 to 176. If it takes them only 5 years to get there, 176 divided by 51 to the 0.2, it needs to make 28% a year. The stock needs to grow 28% a year from today.
That's insane.
Is it possible? Well, sure. I mean, look at this. It went like that here. So guys,
How many years is that? 20 years? So does it do 28?
No, this right here is
No. This is not, but I mean, what you just said.
5 years.
5 years.
Yeah.
28% for 5 years.
Yeah.
It's not out of the realm of possibility, but
No,
it's
but
not.
But I look at the price to sales ratio
wouldn't bet
thinking,
on that.
yeah, I'm looking at the price to sales ratio thinking, man, it seems a little rich.
Yeah.
I don't know. So guys, if you're new, you need to subscribe to the channel and you need to share this video with other people because we don't look at every stock and say, how do I find a way to buy it? We look at every stock and say, okay, is this stock worth our time? And we just peel back the layers. Go
How do
ahead.
we find a way not to buy it?
You know, it's funny. Gary does that.
Professional saying no.
Yeah, and Gary's a big believer in looking for a reason not to buy stock. I don't believe that because there's always a reason to not do something.
Exactly. You'll never make an investment if you
Correct.
look for a reason to say no.
Now, are there varying reasons that matter? Like one being, you know, spoiler alert, we have a video coming out in the next few weeks probably about a company we've been talking about lately that we think could be a multi-bagger. However, one of our Everything Money community members has reached out to Mo and I and said, guys, I think there's some suspicious accounting things happening at the company. And we're going to do a breakdown with him and then do a video on it to kind of explain by the way, his comment has validity to it seems. However, it doesn't affect the free cash flow, but it says a lot about the management.
Right.
And that's the reason why we're kind of concerned about it. Right. So if that's the kind of understanding you want to do on investing, subscribe to the channel. That's what we do, 2 or 3 videos a day. We love doing it. We report during earnings season. If you like the software with the 8 pillars and analyst estimates and stock analyzer tool and all of our other tools up here, less than $1 a day. In fact, we're running a special, $7 for 7 days. Go to everythingmoney.com. Check it out. Thank you very much for your time, everyone.